In this video, we are going to talk about Aurizon with the ticker code AZJ. Aurizon is the largest rail-based transport business in Australia, and it provides a critical service to Australian coal export industry. Aurizon is also known for being a dividend stock, a very defensive stock. Since September 2019, the share has been declining in value for about 40%, and it was recently traded at $3.40 or a market capitalization about $6.4 billion. But if you look at the share price of Aurizon since 2010, there hasn't been major move. It was traded at $2.80 in 2010, and over 11 years, it has gone up by about 20% to $3.40. So in this video, we are trying to answer the question, is Aurizon a good dividend stock? And we're gonna do a 10-year review. We're gonna look at the balance sheet, the earning performance for the past 10 years, and lastly, we're gonna talk about the main important thing investing in Aurizon, that is the risk that it has in the energy transition world that we have right now. I'd like to thank David Wilson for recommending us to look into Aurizon. Another interesting fact is that Argo and also Australian United Investment, one of the biggest LIC in Australia, owns a substantial amount of shares of Aurizon. If they hold it, they must have seen Aurizon as a good dividend stock as well. Let's start with Aurizon revenue for the past 10 years. In 2012, the revenue is about 3.5 billion and it goes up to the 10-year high, about 3.8 billion in 2014 and 2015, and over 10-year period, it has gone down to its lowest in 2019, about 2.9 billion, and recently in financial year 2021 of about $3 billion. So it was 15% less than it was 10 years ago. And if you look at the balance sheet over 10-year period, the total asset remain about the same, although you need to pay attention of the discontinued operations that they have over the past 10 years because it will affect the earning potential that they can have. But one thing is for sure, for the past 10 years, the net asset has gone down, which is a sign of higher amount of borrowings or liability. And in financial year 2021, Aurizon has the highest borrowings and liability that they have, so we need to check further with the capital expenditures and are they spending that borrowed money the best that they can. So the revenue has declined by 15% over a 10-year period. However, the profit after tax has been increasing. Back in 2012, the profit after tax is about 450 million. In 2021, it was over 700 million. But we need to pay attention to the biggest risk investing in Aurizon, that is the climate risk, the unforeseen disaster risk. In 2016-2017, Aurizon reported the lowest net profit or even a net loss in 2017 due to Cyclone Debbie. Cyclone Debbie is the strongest cyclone to hit Queensland since 2011, and you need to be prepared that this may potentially reoccur again in the future. It has the speed about 175 to 200 kilometers per hour. That is really fast. And Cyclone Debbie caused a devastating damages to a lot of people, not just Aurizon. Aside from the reported net loss in 2017, Aurizon has been paying steady dividends for the past 10 years. You see the orange bar here are the dividend per share. Back in 2012, the dividend per share was about 8 cents per share. In 2021, it was as high as 28 cents per share. And on top of that, they've been doing a share buybacks for the past 10 years. They spent about $2 billion in doing that. And as a result of that, the weighted average number of ordinary shares has gone down about 570 million. Used to be about 2.5 billion shares. Now it was down to 1.8 billion shares. The share buybacks is most likely due to Aurizon's inability to increase revenue. Aurizon own the infrastructure of tracks, and in that way they are kind of like a monopoly. But the amount that they charges to other third party is monitored by QCA or Queensland Competition Authority. So for Aurizon to increase their profit after tax, they need to reduce costs. They need to reduce how many diesel they use. They need to be more efficient and make sure everything is done with the highest safety standard as possible, hoping to God that there's no unforeseen disaster that will disrupt the transport business. Aside from that climate risk, we need to consider the bigger risk of investing with Aurizon because the future is changing. For the next 100 years, our world will experience the energy transition, which will affect coal demand. And if you read the sustainability report from Horizon, they already consider all the cases, or even they are prepared what if the coal price plummets to as low as $50 per ton. And on top of that, we need to consider the tension that we have with trade situation with China. China is now not taking as much Australian coal, and now the majority of Australian coal export goes to other countries such as Japan, Southeast Asia, and India. So coming back to our original question, is Horizon a good dividend stock? Based on what they've been paying for the past 10 years, it sounds like it is. But if you look at 10, 20 years from now, you have to consider a lot of this risk that could happen, and it could change the whole balance sheet and especially their revenue. That is, if the world doesn't need coal as much and their revenue plummets by half to 1 to 2 billion, and then they may incur loss because of a lot of the depreciation. And it is a very capital intensive business, and as of financial year 2021, they have the highest borrowing for the past 10 years too. So let me know, what do you think? Is Horizon one of the best dividend stocks in ASX?